So the TSX closes at its lowest level since August 24, 2010, dropping 392 points to close at 11,562. What do we do with this market volatility? Joining us in Toronto, Richard Croft, the president of RN Croft Financial. Jeff Parent is portfolio manager at Quadrax Asset. He joins us from Calgary. And in studio, Darren Farwell, senior wealth advisor to Farwell Wealth Management. Gentlemen, thank you for joining us today.
Hello.
Hi.
All right, Mr. Croft, let's start with you off the top here. Operation Twist sort of threw out a hip more than anything else, didn't it?
Well, they put $400 billion to work here, which is basically about 1 year of long-term bonds that the United States Treasury is going to issue. They do about $13 billion a month. Their portfolio is now going to be spread about evenly between short, mid, and long-term debt. I don't think it's going to do anything at the end of the day. I guess the positive side of it is if we get some reduced yield on the longer-term bonds, which certainly that has happened, it might encourage some investors to move to risk assets, figuring that there's simply nothing to gain by having bonds of any kind.
Now, Darren, when your phone rings, what's the big concern on the other end of the line?
A lot of people are wondering just how bad can things get. Is this going to be like 2008? Should I sell everything now because things are going down 50%? Or should I be holding on and get my dividends and wait for things to get better? That's what people are asking.
Now, Jeff, from a technical perspective, do we see a bottoming point here for the TSX Composite Index?
Well, it looks like that right now, and a little bit of the activity towards the end of the day might have been some covering. It did push the index above the 11,500 level. That'd be the TSX Composite, so that's partially encouraging. If I was a short-term trader, I might be looking to buy tomorrow morning if we have a positive opening. But technically, we are at support. It's not the strongest support. There's more stronger support points that we saw last year, earlier on in 2010, hitting, and that was 11,100. So if we break through and we can't hold the 11,005 level, I think we're going to see another 400-point drop. But I'm slightly cautious right now.
Okay, so
optimistically cautious.
Optimistically cautious, Mr. Croft.
Sorry, cautiously optimistic.
All right, Richard. So, what's your take on this? Do we just buy, the widows and orphans stocks and stop opening up our portfolio statements?
Well, it's always good not to open your portfolio statements in times of turmoil, certainly, but I would use what I call a barbell approach to investing. I think you're going to have, on the one hand, your very mature companies with very good dividend yields. You spoke about Royal Bank as an example, the 4.7% yield. There's a couple of Canadian banks now sitting at a 5% yield. BCE, that was actually up today. It's got about a 5.5% yield. I think these are stocks that I would look at for defensive purposes, and I would collect the dividends. The other side of the coin would be to look for companies that are going to give you growth in any market. There's not a lot of those out there right now, but certainly you alluded to one of them would be Apple in the current market environment. Another one I would think of would be Chipotle Mexican Grill would be a company in that space. Maybe Google would be another one.
Whoa, hang on. Chipotle Mexican Grill? I thought in times like these Americans were pinching pennies.
Well, there's lineups down there, and they just launched a new restaurant chain, so I think they're a pretty good company, and they seem to do well, and they held up pretty good today, too.
Okay, now, traditionally we talk, Darren, about going to the big banks for safety. Is that a safe place today?
Well, the big banks are a safe place because they have an essential business, basically a monopoly on the Canadian financial sector, and they pay a good dividend, and they haven't missed a dividend in, boy, as far as I can remember recorded. So, of course, it is a good, safe place to be. And a barbell approach is probably a good one. Get those banks to get the dividend and keep your dividend payment while we wait for the market to get better. On the other side of the coin, stocks that have a lot of growth, those commodity stocks are getting hammered down. Seems our models are indicating that there are some prices below where we are today, but a great time to pick those up because they'll be moving up quickly when demand changes.
Jeff, I'm looking at the volatility index here. The VIX spiked back up to the 41 mark, and whereas historically this is more of a trade around the 14 mark, but I've been told lately that those days are well behind us and this is the new normal. Do the charts back that up?
I think the long-term trends are still going to be effective, and we'll see the VIX trading down below 20 eventually. We're in a moment of panic. There are cycles in volatility. Obviously, this is a peak, and the VIX is going to move accordingly, but there are troughs, and it is very, very cyclical. You have to have a look at a long-term history of the historical volatility. But it is something that will subside eventually. I don't know how soon it'll be, but I think before the end of the year we'll see it in the low 20s at least.
Right. Jeff, I'm looking at the RSI as well, and it seems that the herd mentality has pushed the TSX Composite Index for the first time since August, early August, into oversold territory. How long, historically speaking, from a technical perspective, do we find ourselves oversold in Toronto?
Well, the RSI is a good indicator for doing the opposite of what everybody else is doing, and it's also, you got to keep in mind that it's looking at about a 14-day trading period, so about 3 weeks. And if we are at a range in the past 3 weeks at the low end of the range, then the RSI is going to be reading a fairly low level. But the spike downward as well also helps it create a lower than average level. So, you know, that indicator would be telling you to buy right now, but the way that the system works is that you have to wait for a reversal, at least 1 day. And this is one of the critical components of technical analysis. For longer-term traders, at least, you need that confirmation. And, of course, today is the first day. Tomorrow will be the follow-on day.
And whether or not we see an upside bounce depends, I suppose, on whether or not, Darren, we're going to get a recession in the United States. You think we might see a mild one?
It looks like there could possibly be a mild recession. No one's quite saying it yet, but it looks like it could be maybe a negative 0.4%. Nothing too severe and nothing too long, but it is possible to get a mild recession, of course.
Now, with that sentiment in mind, why didn't we see gold bounce today? We'll put that question to our panelists when we come back after this short break.
I have the good fortune of being in a job that really grounds me. I work in community and stakeholder relations. The stakeholders I generally deal with are First Nation, Métis groups. I deal with water issues, air issues, land issues. There is merit in having their views understood. I move us along that path in terms of trying to find that common ground. It's the only way that I see us moving forward. We are on the right path in terms of trying to address issues of such importance for everyone.
With iShares fixed income ETFs, there's a lot built in, like the dependability of laddering to lower volatility and ensure steadier income. And it's not only in our funds, it's in our DNA. iShares ETFs, listed on TSX.
You are a business pro. Princess of the PowerPoint. Your core competency is competency. And you rent from National, because only National lets you choose any car in the aisle and go. You can even take a full size or above and still pay the mid-size price.
I'm getting an upgrade.
Indeed, business pro, indeed. Go National. Go like a pro.
There's a right way to do everything. Doing the right thing doesn't have anything to do with political correctness or popular trends. It's not about numbers. It is simply this. You have a deep understanding of what should be done, and no matter what, you are honest and relentless in doing it. Russell Investments.
The day's top business news. Before the opening bell, get the BNN newsletter. Delivered fresh every weekday morning. Sign up at bnn.ca.
When markets tumble, we usually see a flight to the safety of gold. That didn't happen today. Let's go back to Richard Croft as we talk about why that may not have happened. Richard, first of all, was this just margin calls? We had to sell anything that was liquid?
Well, it might have been some of that, but I think the real issue was that the U.S. dollar advanced, and gold is priced in U.S. dollars. And I think that this once again points to the real crisis insurance of the world. You need a very liquid vehicle, which everybody at the end of the day, in a worst case scenario, believes it to be safe. And that's what I think happened, and we saw it with the Canadian dollar falling so strongly. And I think the gold got hit pretty much the same way. I think that was the main reason.
Jeff Parent in Calgary, where does gold go from here if it's at $17.40 today?
Well, it's looking very bubble-like. I think right now we're in this period where everything's more or less correlated very highly in a positive way. So we see a lot of things dropping. The currency, of course, is going to be stronger because that happens to be the most liquid trade. Gold, I think, is on the down slide. And I think even if the markets recover, people might be looking for other things, maybe like copper or other industrial metals. It's always been a speculative metal.
I do want to talk about copper, but first of all, let's look at this little spot here I'm looking at on the screen. You've often told me in the past that when a stock rallies substantially, we often see it pull back to pretty much the same degree. Do you expect gold to revisit the kind of level that I'm looking at here on the screen at about the 1700 mark and less?
Well, yeah, there's a reversion trade, and this is all about the idea of traders taking profits. It's a pretty straightforward concept. You are selling off gold because of the Canadian, just because you want to take your profits. We do see a price drop because of the fact that the U.S. dollar is so strong, but I think it's a much bigger trend, and the idea is that as the profit taking goes on, people will take more and more profit. They don't want to be last out. We'll see probably another drive down, maybe after a small bull move, but I can see it going well below 1700. I mean, that 1700 is not a big stretch right now. It's so close to it right now.
Yeah, you're nodding your head in agreement, Darren.
I think absolutely. I mean, we've seen bullion, I think, probably reach a peak. It reminds me of the early 80s when gold had a parabolic rise up to hit the all-time high for that time and then had an equal move down. We've gone through the 150-day moving average. We're probably going somewhere towards the 200-day moving average, which is 1585. And the thing that was a real indicator to me is I remember one of the days close to the gold hitting all-time highs, walking down past the precious metals desk at one of the major Canadian banks, and there was a lineup around the desk of consumers, retail investors, looking to buy gold. There was a sign, 1 ounce, 5 ounce, 10 ounce bars, all sold out. You know when the retail investors are lining up to buy this stuff and it's all sold out, there's got to be a top there somewhere.
All right, but Richard Croft, if you're not buying bullion right now, do you buy gold stocks because they haven't rallied to the same degree?
Well, this goes back to the VIX, and if we could return to that for just a second.
Yes.
You talked about that being at a high, and you're right. The VIX is not a trend is not an instrument that's going to follow a trend. It tends to trade in a range, and it's certainly going to come back to some norm around 20. So what it's really telling you is that option premiums are very expensive right now. Gold stocks, in my opinion, make excellent stocks to write covered call options against. So if I'm looking at this market today and I'm trying to find something that I can latch onto, I have to find something with certainty. And the one thing I know right now is there's a lot of risk in the market that is priced through options. Option premiums are very expensive. Gold stocks are instruments that, as you say, haven't followed gold quite to the extent that they should have, and we're starting to see them catch up a little bit lately, but they came off today too. I just think that if you're going to be into gold stocks, write covered calls on them, take the cash flow. It follows the same theme that I talked about with dividends, only instead of collecting dividends on the gold stocks, what you're really doing is collecting option premium, and you're taking that part of your cash flow and reinvesting in other things.
Jeff, what's the prognosis from Dr. Copper?
Well, I think it's going to follow the markets. Should start going up a little bit, but you got to be careful. You hear in the news something. What was the story about China building up inventories? That's a small indicator. And I'm sorry, I don't have the full story here. Maybe you've talked about it earlier, but you got to look at the inventories and make sure that there's going to be some use of it in the economy. Things like new home sales are going to drive that, of course, but it is an indicator, and people are going to be treating it like a regular industrial commodity. It'll move up and down with the markets. I think it'll probably stabilize maybe around the 380, 390 level.
Now, Darren, I know you like Teck Resources,
Yes.
but is it for the copper side or is it more for the coal side?
Well, actually, it's a little bit of both. What we like is Teck Resources at prices quite a bit below where they are now, but there's a price at which we'd like to buy it because we know that someday demand's going to come back. Right now, it's not there. When demand comes back, those are the kind of companies that will rise very quickly.
All right, if you don't want to pay 31 and change for Teck today, well, what's a more reasonable entry point?
Well, we actually have prices in our model say we will really like to buy it at 23. Now, if it doesn't get there and markets reverse direction before that, we may change our mind, but right now we like 23.
All right, coming up next, the loonie tumbles out of the gate, closing at 97.3 cents U.S. What caused the drop? What does it mean to your investment portfolio? Perspective when we come back.
Canadian Natural Gas. It gets us going in the morning, offers a cleaner ride to work, lights our way home. It helps us cook our favorite meals, keeps us warm, and is found in energy-efficient buildings across the country. It's right here when the sun sets and the wind dies down. Canadian Natural Gas. Cleaner burning, affordable, and ready now. It's tomorrow's energy today. Discover the possibilities at CanadianNaturalGas.ca.
Savvy traders know that real opportunities exist in the commodities markets, not just the stock markets. Trade at cmcmarkets.ca.
The Lexus RX, once again recognized for excellence in the category it created. Now available with a $3,000 cash purchase incentive or 2.8% lease or financing. Pursue the moment. Lexus.
You researched, compared, and bought your last 5 trips from the same travel website. Maybe it's time to invest in the company. RBC Direct Investing. It's like online shopping for investments. Open your account today. You can do this. Member Canadian Investor Protection Fund.
Doctor, we're losing her. I don't know what's wrong. I can't find the inferior vena cava.
Oh, come on. It's right there. It's crystal clear in HD.
Well, why did 2D I missed it?
Doctor, we're losing her. I don't know what's wrong. I can't find the inferior vena cava.
Good call. There it is.
I found the inferior vena cava.
That's why I love you, Nurse Cowboy.
But you're married to my mother.
If she makes it through the surgery, I'll tell her everything.
Yes!
Are you for real?
Closed captioning of this program is brought to you in part by B2B Trust, because borrowing to invest is smarter than borrowing to spend.
The loonie back below par. Is this a correction back to the normal levels against the U.S. dollar? We turn to our panel for this again. Darren, you think the buck could fall to as low as 94 against the greenback?
Yes.
Why?
Well, let's face it, the headlines are battering the market. When there's good news about whether there's going to be a resolution with the debt situation in Europe, markets go up, and when there's bad news, markets go down. Recently, we've had a lot of news about negative global growth. Numbers from China today, those PMI numbers below 50 2 months in a row, that's bad news for global growth. We were counting on that for North American growth. So that all says lower growth, lower commodity prices, lower Canadian dollar.
Jeff Parent in Calgary, do the charts back up an expectation of 94 cents?
Well, if you look at a very long-term chart, you will see a very clear downward trend for the U.S. dollar against all currencies, the Canadian in particular. The currency, I think, has a very stable area around par. Today's trading activity is mostly because of the panic in the markets and the flight to safety, as we so often call it. I think it could be short-term. But if you look at a chart, you also see something that might contradict with what I'm saying, a double bottom around the $5 level, and a breakout through this par support. And so it's a little bit scary from that perspective. So we'll have to wait and see. I think it's too early to make any judgment on where it's going to go. I prefer to think it's going to stay around the par, simply because of the very long-term downward trend of the U.S. dollar against especially the Canadian dollar, but you see it also in the euro and various other currencies.
So, Richard, as an investor, how do we play this expectation for the future direction of the loonie? Do we do so by buying stocks that aren't exposed, or can we actually play the currency game ourselves?
Well, you could play the currency game if you wanted to. There's some currency ETFs out there that you could use. I think the reason that the Canadian dollar is down has been put out there pretty well, and that the U.S. dollar was panic-driven and people went there. Could it go to 94 cents? Well, if the market continues to fall and there continues to be panic in the streets, certainly it could. It certainly had that kind of move in 2008 when everybody was rallying to the U.S. dollar as well. I think Jeff made an interesting point, and I actually tend to agree. I think at par, the dollar is probably fairly valued. It's going to go up, quite frankly, when the market stabilizes and we start to get some growth back into the market. I think the Canadian dollar on its own, in a stable environment, is probably a good place to be. How would I play that? I probably would avoid putting all of my dollars or my money into U.S. dollars, certainly put maybe no more than 25% of the portfolio there. Certainly for my clients, we've been, for the most part, using Canadian stocks this year, and we think that that's benefited us on the long term, and I think we'll continue to do that. And I think you have to take these one-off days and just accept that as part of the market volatility.
Richard, CDS Market telling us there's a 96% chance that Greece is going to default on its debt.
I think it's 100. So
okay.
I wish they would do it. I wish they would just get it over with.
That's what we need.
I think that's a big part of it. The problem we face here isn't so much Greece. The problem we face here is how does the default take place? And the real concern is that it spreads to other parts of Europe. We all know that. That's all but in the news. And the solutions or what Greece can do about it is also a big challenge because they're part of the Eurozone. If you want to look back to 2008 and look at what happened in Iceland, they're starting to grow again. They're actually doing okay over there. And that was a country that defaulted 2 years ago. And they had to take some major steps to turn that economy around. But what it did show is that an economy can turn very quickly when given an opportunity to do so. Iceland devalued their currency. Greece can't do that. They're part of a Eurozone. They let banks fail in Iceland. Greece probably will have to face that scenario. Certainly Europe is not going to let some of those other banks fail. And again, they've put some money aside for that. Mr. Geithner thinks it's far too little and perhaps way too late.
So, Darren, the euro rises, but not until we get a credible plan out of Europe.
Exactly right. We got to have a plan. Guys, give us a plan. It's not like the problem's going to be fixed tomorrow, but we need the plan that will get it fixed. When we get that sort of clarity, businesses are going to be able to lend money and grow.
Confident that the politicians overseas there, Richard, are going to be able to pull that off?
I'm not confident in any politicians at the moment. I think that what you're seeing going on in the United States is nothing but a political grandstanding by both parties, and I think that it's going to be a do-nothing session until the presidential election. I think what you've got in Europe is that multiplied by a factor of 10.
Or 17, as the case may be.
Or 17, if the case may be, absolutely.
Good point.
Darren, final thoughts to you?
Well, we're in a recovery phase. Let's not forget the fact that this is a recovery. We're not going into a serious recession. Recovery has 3 stages. The first stage is led by government spending. That's behind us. The middle phase is the patient's still a little bit sick. We're not all better yet, but we're going to come up with a plan to make sure it happens. The third stage is businesses step forward and start hiring and investing for growth. That's coming, and that's what you want to get ready for.
All right. And, Richard, before we go, you didn't lose your mustache in this market, did you?
No, I shaved it about a year ago after 40 years.
Wow. Good to have you with us, gentlemen. Thank you so much. Joining us in Toronto, Richard Croft, president of RN Croft Financial Group. In Calgary, Jeff Parent, portfolio manager at Quadrex Asset Management. And joining us in studio, Darren Farwell, senior wealth advisor to the Farwell Wealth Management. Remember, if you missed any part of BNN's Market Turbulence Special, visit bnn.ca for the replay. The TSX Composite Index returns to levels not seen since August of 2010 on a percentage decline basis and August 2011 on a total value basis. Energy, materials, financial services sector pulling us to 11,562.